Hello everyone, I'm Kelvin William from BBA International Business School, and today I would like to do an explanation of my mind map as my assignment in International Finance class by Professor Roy Sembel. So, first of all, we will explain about the international finance. First, the corporate finance. So it's just basically like a brief reminder of what we have learned in our previous semester. So briefly, we cover about what is the core value, the principle of value creation. The first is at the core of value, which is a healthy cash flow drive growth. The second is that the conservation of value, like a value generated when the return and growth is bigger than the WACC. And the third is the expectation of treadmills. It's like a performance expectation by shareholders and fundamental performance. The fourth is that the best owner principles. So basically, business value depends on who owns or manage it. So the second is that the trade-off between risk and return. It's the main focus here is basically the time value of the money. So the four factors including future value, present value, interest rate, and number of time period, which I believe we are pretty familiar with already. The third is that the six sources of corporate value. So the physical asset and financial asset is a part of tangible asset. Physical asset will be including land, machineries. Financial asset will be about the cash, investment, source of debt, and equity. And the last four is the intangible asset. First is that the customer asset, which is the relationship between us and the customers. Employee and supplier asset will be the high skilled labor or efficient supplier. The third is that the organization asset, which would be like intellectual asset, leadership, core values, and the last, the reputational asset, which is the public support and the good corporate citizen. Now we're going to the capital budgeting method. Just really brief. It's basically a payback period, net present value, PI, and ERR. So we're coming to the new topic about principal agent problem. So what is principal agent problem? So like it's a conflict that may occur between shareholders and managers within a company because of asymmetric information. What is asymmetric information? It refers to when one individual or party have more information compared to others. So it will lead to the example of adverse selection and moral hazard. What is adverse selection? It's a poor decision making because made based on a weak knowledge or understanding. The example would be like when buying second car, let's say that you don't really know about the cars, and the sellers are trying to make it look new and good, even though the machine isn't good. And the last is that the moral hazard. Um, it could be happen in a situation of shareholder and manager. Let's say that managers are working for themselves, and shareholders expect managers to work for their interests. Moral hazard occur because um, manager increase the risk for the shareholders. So how to overcome this problem? The first step to have a better training, better recruitment, a specific contract with a KPI incentive. Could be fire a manager who doesn't perform well and take over the management. Okay, we come to the new topic of MNC. What is MNC? So it's like basically a company that headquartered in one nation, but the operation division is spread with the nation to serve a bigger market. Why they want to be an MNC? First, they could serve a bigger market. Third, they seek for a raw material. Third, they seek for a production efficiency. Fourth, they seek for a knowledge. Five, they seek for a political safety. What is the benefit of become an MNC? The benefit is that investment opportunities and financing opportunities. Investment opportunities is referred to a when a MNC have a better marginal return compared to the domestic firm because they have expanded opportunity set of possible projects from which to select. While in financing opportunities, they can obtain the capital funding at a lower cost because they have larger opportunity set of funding sources around the world. Now we're coming to a new topic, which is a foreign exchange. So I'm just gonna do a really brief about the system itself. So there is three systems. The oldest one may we know is the gold standard, and there is this fixed exchange rate and a floating rate system. So the transaction type in foreign exchange is based on two rate, which is a forward and spot rate. So spot rate is basically using the current state of the foreign exchange, while the forward state is that when you can buy or sell things on a specific rate on a specific time, regardless how spot rate has changed. Now, what factors that contribute to foreign exchange? It is for sure a demand supply of foreign and domestic currency, split into three parts: the risk perception, securities of between two countries, and goods service between two countries. The goods service between two countries is influenced by inflation rates within countries, the relative income between countries, and the governor restriction of goods and service flow. As for securities, it's the interest rate and the governor restriction on capital flow. Last is the risk perception. So that's a factor that will contribute to the foreign exchange. Now, we're talking about arbitrage. Arbitrage are separated into three parts: locational, triangular, and interest rate. So basically, locational is just we utilize the discrepancies across two countries. The triangular is three countries, while the interest rate is that we are we are utilizing the forward market and the interest rate differential between countries. So basically, like you see the interest rate is the differential is high, and we put our money into a forward rate and will sell it in the future to gain profit. Okay, now we come to the forecasting. The forecasting is, oh, I'm sorry, but I should talk about the international theories of arbitrage for sure. So it's our PVP, IFE, and ERP. So this is the comparison of ERP, PVP, and EFE. So PVP is explain the rationale of how inflation rate and exchange rate within countries should be equal over time. So that's why the factor here is on the inflation rate differential to the exchange rate expectation. While the Fisher effect is explain the rationale of how interest rate differential will affect the inflation rate differential, and it will affect the foreign exchange rate. So that's why you can see the factor here is the inflation rate to interest rate and interest rate to exchange rate. The last is the interest rate parity. Um, it's ac- it's a concept of rationale of no arbitrage between countries in relation with the interest rate and foreign exchange rate, as countries trade with the forward premium and the forward discount. Okay, we're going back to the forecasting. We have technical, fundamental, market-based, mixed, and forecasting of volatility. So basically, in technical, I believe we're pretty familiar with all the statistical method and the time series of model. While in the fundamental, we're taking a look at the economic uh, variables and the exchange rate. While for the market base, it's heavily based on the rate, which is spot rate and forward rate. Mix is a combination and the weighted average of all of the methods. While to forecast a volatility, there's two types. You can use the pattern of volatility based on the historical application and time series, and implied standard deviation derived from the currency option prices. Now, we come to the efficient market hypothesis. What is efficient market hypothesis? It basically says that all stock prices reflect all the information, so no one can take an advantage within the market. Like no one can use any investment strategies to beat the market. Okay, and it's now split into three types, which is a weak form, semi-strong, and strong form. Weak form is says that today's stock prices reflect all the data of past prices and that no form of technical analysis can aid investors. While in the semi-strong, it says that investor cannot utilize either technical or fundamental analysis. But even though information not available to the public maybe can help investor. Now, the last, which is the strong form efficient, it's explained that all information, public, not public, is completely accounted for the current stock prices, and no type of information can give an information to an investor to take an advantage on the market. So no one can beat the market within this strong form efficient. Okay, I think that will be my explanation of the mind map. Thank you for listening.